Guys, we are opening up today with a big down market. Futures last night had dropped about 1.5% down on the NASDAQ. And guys, right now, the NASDAQ had been falling to almost 3%. It's now 2.26%. It's early on in the day. This could rebound. This could go worse. We have no idea. Now, Trump has called for a Liberation Day, which is a 20% tariff for some BS across the board. Guys, tariffs are inflationary. They're just a tax. That's all they are. You know, Tim was just telling me that I saw these billboards up in Cleveland on 271 saying tariffs are just a tax. They're 100% right. It is just a tax on you guys. It's just a tax on me. It's a tax on everybody, because at the end of the day, a business selling a product is going to just increase the cost of their product to the consumer to account for the tax. That's it. It is to account for the tariff. That's it. It's just a tax on us. That's it. So again, here's the market. Pretty red right here. And obviously the big companies are down a lot. Google, not as much. I'm surprised, only 1.5%. Tesla down 7%. I believe Palantir somewhere is down another 7%. But you've got Microsoft, Nvidia is down 4.7%. We've said this before. We'll say it till we're blue in the face. The stocks that drive up the markets when there is a pullback or a correction, a bear market, these stocks are going to lead the market down. But remember, there's still some green here. There's green in every market somewhere, right? Unless there's like a massive quick crash like they had for COVID. But look, there's green in utilities. There's green in real estate. There's green in insurance. There's green in consumer defensive, beverages, things like that, Procter & Gamble, companies like this. There's always some way. But remember, we're not teaching to jump in and out of markets, in and out of industries, in and out of sectors. That's not the right way to invest. The best way to invest is to make a decision and sit on your hands. And that's very tough to do, because we sit there and feel like we have to be doing something. If we're doing something, we're making changes, we're making ourselves better. Not necessarily. That is not the case, especially in investing. Less is more in investing. Now, guys, stock market GDP, 10-year cyclically adjusted PE ratio. We look at these things from stock market valuation. I created my own S&P 500 stock market to GDP ratio going back to like 1930. And there's the 10-year cyclically adjusted PE ratio going back to 1870. I talk about these in every video. If you would like access to these, if you want me to email these to you, do me a favor. Click the link in the description below. Give us your email. We'll send this to you absolutely free so you can have these. Now, does this mean you should use these as a timing mechanism? Absolutely not. But it's just to remind you that valuations are very high. This is the 10-year cyclically adjusted PE ratio. It takes the last 10 years of earnings, brings it to today, accounting for inflation, and we're at 34.75 before the market today. So it's probably a little bit lower today. We're 102% overvalued. Okay, the 10-year, the stock market to GDP ratio, we're currently at 1.88, which is 98% overvalued. Fair value around 2,800. But you guys can see, in the last 4 or 5 years, fair value has gone up. Why? That's one of the benefits of inflation. It's driven GDP up a ton. So again, if you like this kind of data, if you want to be able to have this at your doorstep so you can sit there and update it, click the link description below. It's absolutely free. You'll get it emailed to you. It's a wonderful reminder of where we look at in valuations, where we look at for the future. Remember, guys, every investment's the present value of all future cash flows. But the more you pay for something, the less your return's going to be. Simple example, iPhone. $1,000 iPhone, you pay $200. You make a lot more money than if you pay $2,000. You lose money if you pay $2,000. The same item, the same stock market, the less you pay for it, the better it is. But it's hard. Because when things go bad, there's all these stories. Guys, who would have guessed a year ago? Remember, we've always said in this channel, in our main channel, in a room filled with gasoline and a fireplace at the end, burning off fire, there will be a spark that caused the explosion. Which one? We have no idea. But when the room is filled with overvaluation, that spark could be anything. Who would have thought 6, 7, 8 months ago, a year ago, it would have been tariffs? And that could be the justification for it. Or, you know what could happen? All of a sudden, Trump says, I'm not going to do it, and the markets surge back up again. We have no idea. But the point is, I want to remember, look at this. This has been a pretty scary market for a lot of people. Not people in our community. In our community, people who watch our channel love down markets because they love things on sale. That's the mentality I want you to have. You need to have that mentality because guess what? In history, markets go like this. Consistently. Let me show you guys what history has shown and all the bad things that have happened. Guys, this is the S&P 500 going back to 1950. Here's a fraction of all the awful things that have happened. JFK assassinated, Black Monday, 18% mortgage rate, stagflation, something being discussed a lot today. Stagflation is a stagnant growing economy with inflation. That was bad. And look at the markets. Look what happens. They go up. Now, are we massively overvalued here? Yeah, I think so. But even if the market fell in half, it's a still pretty good chart. Still a pretty good chart. Why? Because if you believe in the U.S. economy, if you believe in the long run of it, you'll probably do well over the next 20, 30, 40, 50 years. You might sit there and say, Paul, 50 years, what the heck? These things do matter. People are living longer. So even if you're 25 right now, you sit there and say, 50 years from now, I'll be 75. Yeah, you probably have another 20 years to live, 25 years to live after that. That's a very high likelihood, especially for the people watching our channel. Now, if you're international and you like exposure to US stocks, again, don't leave what you're doing. This is very important. Unless you have other sources of income out there that you don't need to be in the market, stick to a plan. Stick to that dollar cost averaging every single month because of things like this. And guess what? As Warren Housel always says, every past bear market or crash looks like an opportunity. Every future one looks like a risk. You know what? At every single one of these, people were scared like crazy. Every single one of these. And if you were to pick only 7 or 8 times to invest in the past 35 years, you'd have picked those times. Do you see what I'm getting at? That's the kind of people I need you to be around. That's the kind of thinking I want you to have. Now, guys, on Friday, consumer sentiment came out. It wasn't great. The final version of the University of Michigan's Closely Watched Go Blue survey showed a rating of 57 for the month, down 11.9% from February, 28.2% from a year ago. Guys, consumers are getting worried out there. Consumers are getting worried. Auto loans, mortgage default, these are all getting worse right now. Does that mean you should panic? No. This is part of a cycle. We don't know what's going to happen. I've seen these numbers before, and the market keeps going up. The economy keeps going up. I don't know what's going to happen. But all I do know is these things will happen. And guess what? You will be better off after it. If you properly save, you properly invest, you will do great. Now, this week in the market, not much coming out. We've got these auto sales coming out. This will be pretty interesting to see. The last reading was 16 million. We'll see what happens with these. ADP employment, a lot of things, factory orders. I don't know. I don't want you to get too bogged down worrying about the small data in the economy. Now, does that mean that you shouldn't look? Again, if I were to ask you, okay, let's say we are in the middle of a recession right now. Does that mean you'd sell all your stocks? Well, why would you sell your stock? If you're in a 401k, IRAs, you can't touch it to 59.5 or 60. Why would you do anything? So all you have to do is sit there and just be calm and say, yeah, I temporarily feel poorer, but you're not. You're buying great companies at better prices. That's the key. That's what's really important. And there are opportunities and there are ways to outperform the market as you go along. And this reminder, the reason I want you to sign up for the Excel sheet for the valuation is not to sit there and see what's going to happen in the future, to see all the bad things that happened in the past and remind yourself that when things seemed the worst, that was the best time to buy. And when things seemed the best, it was probably time to be cautious. I'm not telling you to pull money off the table. Stick to your plan. If your plan is met and then you have extra cash, maybe be a little more cautious with that cash. That's what I do. If my plan for my savings is met, then I sit there on cash. I have no problem staying there on cash. You might sit there and say, well, Paul, you're missing out on gains. Yeah, I'm okay with that because I have real estate. I have lots of apartments. I have businesses. I don't need to have my money constantly invested. What I'd rather do is pick the opportunistic times for me that work. I want you to do that on your extra cash. On your savings that you're going to get for retirement, you need to make sure you're constantly buying into the market because you don't know what's going to happen on any given month, any given week, any given year. What we do know is I'm willing to bet that even if you bought today, 30 or 40 years from now, the market will be significantly higher. And all along the way, as it was falling, guess what would happen? You'd have bought all the way here and your average would have been right about there and you would have watched it skyrocket. I always bring this example up. The NASDAQ fell 80% from its peak in March of 2000 to its bottoming in August of 2002. But if you dollar cost average starting at the peak, watch your money fall 80%, you still would have made over 14% of your money, including dividends today. And even if the NASDAQ fell in half today, you'd still be well over double digits return with dividends. That's incredible. Just by being simple, because simple wins in investing. So again, guys, appreciate you on this one. Make sure you sign up for that Excel sheet, for that screenshot, the PDF. It is a wonderful, wonderful way to remind yourself of where we are in the market. Thank you for your time.